Well, it is Friday, as I mentioned, but that doesn't mean that we do not have a main focus point for you. And our main focus point today is about deciding real estate or stocks, right? This is an age-old question. A lot of people, their primary savings vehicle, well, it's their house. A lot of people talk about their home equity growth over the years, the valuation of their homes growing over multiple decades. But how does that compare to the market? Well, kind of depends. So we'll dive into all that right now. Now, both real estate and stocks have their merits, right? But the right choice often depends on how comfortable you are with risk, what your resources are like, but also your goals, right? Everything is centered around your goals. So let's start with real estate. Real estate's a tangible asset. You can touch it. You can own properties. You can rent them out. You can buy them and flip them for a profit. Or maybe you don't want to actually own the individual physical building, so you could kind of cheat a little bit and get in the market, right? We're talking about stocks in a little bit, but you could buy REITs, which are stocks. Those are real estate investment trusts. And they allow you to profit from real estate without the hassle of managing properties. I say this to clients all the time. And I think about this myself. When people are talking about buying apartment rentals and whatnot, apartment rentals are great. They offer streams of income. But if you're in your retirement, unless you're outsourcing that work, I doubt the last thing you want to be is a landlord. And so REITs can kind of help with that, right? You don't have to manage those properties. So what are the pros? Well, first, it's easy to understand. You buy property, you maintain it, you do things to increase value, you sell it for higher. You're in control of it for the most part. Certainly there are dynamics that can affect the real estate market, but it's your work, you're doing it. Mortgages can make investing accessible. You can get leverage. You can finance most of the cost up front, and properties can hedge against inflation, right? Rents also typically rise over time with inflation. They move with inflation. That's what's doing it. The property values and the rent's moving. There's also tax benefits. You can get deductions for mortgage interest, but also exclusions on capital gains for primary residences to a certain extent. Now, there are cons too, right? Managing and maintaining properties requires significant effort, sometimes significant money as well. Your pipes burst, your AC goes down, you get flooding. Higher transaction costs like closing fees can eat into those profits. They're also not very liquid. What if you need money really quickly, right? There's the triangle of assets. There's what it is, the price, and how much. And you can't get all three exactly as you want it, right? You can get the price, the timing, and the number of shares is what they say. You can pick two, but you can't have all three. Same thing with your illiquid assets. If you need to get rid of it quickly, well, then you don't really have much room on getting the price you want for it. So that's a downside there. Another thing is diversification is kind of harder, right? If you're investing in a lot of properties, you have to, if you're trying to be diversified, well, you're probably going to have to move amongst geographic regions. So let's say you're a sole owner of these properties. Well, how easy is it to manage all of them efficiently if they're in a bunch of different places? Now, on the other hand, stocks provide an ownership stake in companies and the potential for long-term growth. There's also easier to diversify broadly, even if you don't want to spend a lot of time doing it with mutual funds and ETFs. So let's look at the pros and cons here. Well, one, they're highly liquid, right? You can buy and sell shares in seconds on your phone, on your computer. They're easy and cheaper to diversify across industries and geographies with fewer transaction fees. Most brokers offering commission-free trades these days. There's also tax advantages through your 401ks, your IRAs, your Roths. But there are also downsides. Prices can be volatile. They can rise and fall very quickly. Selling stocks can trigger capital gains, which you're on the hook for in the immediate to near future. Emotional decision-making can also hurt returns. You can panic during market dips, even if you don't need the money for an extended period of time. And historically, though, stocks in the S&P 500 have averaged a 10% annual return, while REITs have returned 11% annually over a long period of time. And so diversification in both can certainly provide balance and reduce risk. But I think the key part is about understanding what you're buying, what the purpose of buying it is, and what the work in holding it will be. So whether you choose real estate, stocks, or a mix of both, the key is really aligning your investment with your financial goals. Not just your financial goals, but your risk tolerances as well. Real estate, it's stable, tangible assets. It offers that stability. It's tangible. Stocks, liquidity, and growth. All of these things come together to help make a better, more balanced, more diversified portfolio.